Larry, before we get into market reaction too, which I'm seeing the dollar sell off a little bit, we've got Treasuries rallying. I mentioned a minute ago the indices kind of limited, but there's a lot to unpack here. I just wanted to start with the non-farm payrolls, 49,000 versus 40 to 50,000 range expected, but I did notice that they revised last month's to down 227,000 from down 140.
Yeah, I mean, it's going to be especially pivotal for financial markets to try to glean through this, because like this number here, it's giving us some context on the lockdown, like the impact it had with the spikes in COVID cases. And also it's telling to me, like, to what extent is stimulus assumptions tied to the number? If we had a number that was greater than 200,000, would it be no stimulus? Bad number, is bad number good now? Hard to say.
Yeah, okay, and there's a lot of pieces to this puzzle. I'm noticing private non-farm payrolls, only 6,000 added. They were looking for 50,000, minus 204 for the revision. It looks like that increased as well. It was minus 95,000. Talk to me here, because another key component associated with this is probably going to raise some eyebrows here, is that unemployment rate coming in at 6.3%. That was a sharp drop. They were expecting 6.7%. Where do you think that comes from?
Yeah, I think it's just coming from that, the beginning of in-person commerce, or at least momentum that we've seen since the lockdowns. I mean, that's my guess without looking into it, and it's something we can see. But I think more restaurants open, more stores are open. They've had lockdowns between Thanksgiving and after Christmas, perhaps, and I think that's the lag that we're seeing.
Interestingly enough, CAD, Canadian unemployment rate, just inched up to 9.4% from 8.9%. Unemployment, they lost 212,000. They were expecting to lose 47,000, so worse than expected there, better than expected here in the U.S., kind of feeding into the narrative that we've been talking about a lot this week as far as U.S. data beating expectations versus international, Canada, Europe, especially Japan, some of the other areas in Asia missing. Let's talk a little bit about the wage component to this, because that's going to be something that's closely watched as well. Average hourly earnings, I saw inching up 0.2%, a little bit below the 0.3 they were looking for, but that might be balanced out by the increase in last month's. They inched that one up, revised it to up 1%, Larry. Prior there was a 0.8% increase. So again, not necessarily heated, but certainly on the rise, 5.4% year over year.
Yeah, definitely. And so it will be interesting to see how yields, the dollar, and the stock market risk assets react to all this, because it might turn out to be where a good number is bad, because everything's baked on, not everything, but a lot of the market's just baked on assumptions for fiscal stimulus. So that could slow down. It's not a priority. That might not be good for risk assets.
Let's talk a little bit about the dollar here right now, because as mentioned, it has been coming off. I want to pull up a chart so we can see some of the price activity that's playing out here. I've got the daily time frame up. Give me just 1 second, because I want to take a look at the 5-minute time frame. The rally we've seen this week, Larry, we're losing some of that momentum to the upside into that 91.60 level. I guess this is kind of a reflection of, well, I guess traders sort of saying, hey, yes, this number could have been worse. The unemployment data pretty strong, I guess, but this is not necessarily anything that's going to shift the Fed sentiment or change the narrative in terms of what we've been discussing here as far as rates to the downside for longer.
Yeah, and I think that's right. And so the dollar's move, in my mind, is fairly muted right now. I mean, just trying to interpret the data and what that actually implies for dollar, because right now we're awash in liquidity. The globe is awash in liquidity. The Fed continues to have quantitative easing. There's a lot of things to pressure the dollar. But that said, the dollar is up. At least the dollar index is up about 1.5% year to date. So it'd be interesting to see if this is a short cover or if it's a longer medium trend.
Larry, does this suggest that maybe this move up that we've seen in rates is putting the cart before the horse a little bit? I mean, again, we've certainly got a lot of optimism out there in terms of some of these vaccines and expectations, but again, in terms of how well received they are and some of the potential pitfalls that still lie ahead, I mean, I guess one could argue that the move up that we saw in rates isn't necessarily justified by what's expected to come here in the very near future.
Yeah, that's a tough one to answer because I think we're still in a range and we're still far away from 1.25% in tens. I mean, we hit that high of what 119 or just about 119 2 weeks ago, and I think there's going to be need to be a lot more bearish impulse in the market to get rates up even higher, and I think justified relative to what? I think interest rate differentials have been such that we've seen that slow rise in yields. Not surprising to me. I would figure this time last week we were trading around 112, 114.
Surprised you to see the indices, continuing to push forward here higher, even with rates on the rise this week?
Yeah, that actually provided me some comfort, I guess, because the S&P 500 near all-time highs, and yields are at a 1-month high or close to it. So that said, it's comforting. So at what point will that begin to unravel? Meaning, if rates continue to climb, when will that affect the stock market? And it's just nice to see that it hasn't to date.
Larry, oftentimes I ask our guests, our viewers, when we have our focus on a big number like this into the end of the week, we sometimes get a little bit of tunnel vision. What should we be dialed in on next week as we come back and focus shifts away from jobs? And while earnings will be a major focal point, I'd imagine as well. Obviously, the indices and these new all-time highs, the coronavirus vaccine. But what else will you have your eye on, and what should our viewers be watching in terms of potential to add to some of the trends we've been seeing or derail some of the momentum in the indices, in this case, the commodities, in many ways, the momentum to the upside?
Yeah, no, I think what I'm looking at, and really the only thing that matters to me beyond headlines on COVID and fiscal stimulus, is we have $126 billion of issuance coming out next week in 3s, 10s, and I think 30s. That's not nothing. And the Treasury continues to have these bigger auctions to finance our deficit. They have to, and they've been well received overall. But at what point does that change? And that's something that I think is, not the secret, but I think that's going to end up driving markets behind the data, and that's something you have to pay attention to.
Larry, do you expect that to change in the near future? You think we'll see that momentum shift here this next week?
I do not. I'm an internal optimist, I guess. I suppose at some point it will, but there's so much foreign demand, and the receive rate to bid to cover ratio has been overall very healthy to so far, and so I don't see it changing anytime soon.